Life insurance is a great tool to prevent or reduce financial hardship on your loved ones when you pass away. But during retirement, is FEGLI worth the cost, or are you better off with a different option? In this video, we're going to discuss what happens to FEGLI during retirement, and we're going to explore the cost of coverage and how it may impact your retirement plans. That's coming up, so stay tuned. Hi, I'm Jerome Harvey with Fedway Financial, and this is the Money Briefing. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider subscribing. When you retire, there are a number of decisions that need to be made. One of those decisions involves your FEGLI life insurance coverage. As part of your retirement application, you will complete Form SF-2818 to indicate if you want to carry your FEGLI coverages into retirement. Your elections are made at the time of retirement, but if you retire before age 65, you will also have a second opportunity shortly before your 65th birthday to choose whether to keep or change your insurance coverages. To kick off our conversation about FEGLI, let's start with a quick overview of the different FEGLI coverages. First, there is basic insurance. It is equal to your annual salary, rounded up to the nearest $1,000 plus $2,000. The cost of your basic insurance is shared between you and the government, and you pay 2/3 of the premium cost, and the government pays the other 1/3. Additionally, there are 3 optional coverages: Option A, Option B, and Option C. You must have basic insurance in order to elect any of the optional plans. Option A is often referred to as standard insurance. It provides a flat $10,000 of coverage. Option B is known as additional coverage, and it provides the opportunity to secure added life insurance coverage at various multiples of your annual salary, rounded up to the next 1,000. You may choose multiples of any number between 1 and 5. Then there is Option C, which is often referred to as family coverage, and it provides life insurance for your spouse and eligible dependent children. It also comes in multiples that range from 1 to 5. You are responsible for the full cost of all optional insurance. It's also important to note, in order to keep your FEGLI coverage at retirement, you must be insured for the 5 continuous years immediately before your retirement date, and you have to retire on an immediate annuity, which basically means your pension must start within 30 days after you leave federal service. If you choose to postpone receiving your pension, your FEGLI coverage will stop until the date your pension begins. For our conversation, I primarily want to focus on basic insurance and Option B because those 2 coverages impact retirees the most. So let's look at basic insurance first. Once you separate from federal service, your basic insurance amount gets locked in at your annual final salary, rounded up to the next 1,000 plus 2,000. For example, let's say your final salary is $112,300. Your coverage will be rounded up to $113,000, and you will get an extra $2,000 bump, leaving your final basic insurance amount at $115,000. The basic insurance has 3 reduction options that start at age 65 or at retirement if you work beyond age 65. You may choose to have no reduction, a 50% reduction, or a 75% reduction to your basic insurance amount. With the no reduction option, the full coverage amount remains throughout your retirement, and the death benefit that's payable to your beneficiaries does not reduce at all. The 50% reduction option decreases 1% per month until it reaches 50% of the original amount. And lastly, the 75% reduction option decreases 2% per month until it reaches 25% of the original basic amount, which takes just over 3 years. Despite having the highest reduction rate, the 75% reduction option is the most popular choice because it becomes free at age 65. The 50% reduction and no reduction options will continue to have a monthly premium cost after age 65. This chart shows the various monthly costs per $1,000 of coverage for the different reduction options before and after age 65. Obviously, the no reduction option is going to be the most expensive of the 3. As I mentioned before, The 75% reduction plan becomes free at age 65. But let's see the total monthly cost of the no reduction plan using the basic insurance amount of $115,000 that we calculated earlier. To get this amount, you have to multiply the $2.25 times 115, and that gives us a total monthly cost of $258.75. Now, let's talk about option B coverage. As I stated earlier, option B comes in multiples ranging from 1 to 5. When completing your retirement application, you may choose to retain all your pre-retirement multiples, or you can lower the number of multiples that you carry into retirement, but you cannot increase your multiples. Starting at age 65, you can choose to have the multiples fully reduced or not reduced. If you choose the full reduction, the value of each multiple reduces by 2% each month until the original benefit amount falls to zero. The coverage will also become free once it starts to reduce. If no reduction is chosen, the coverage will not reduce any. However, the premiums will go up substantially as you age. The cost for option B depends on your age and 5-year age bands. When you have a birthday that moves you from one group to another group, you will begin paying the premiums for the new age group in the first pay period that starts after your birthday. The following chart shows how much option B goes up for each 5-year age band starting at age 50. Similar to basic insurance, the cost is for each $1,000 of coverage. I also want to show how the price increases for option B as you age using the final salary amount from our previous examples. Remember, the final salary was $112,300. Once it gets rounded up to the next 1,000, it equals $113,000. Option B does not get the extra $2,000 increase like the basic insurance amount. The following chart shows how each multiple between 1 and 5 increases starting at age 55 and going up to age 80. As a midpoint, I want to draw your attention to the cost for 3 multiples at age 65 with no reduction based on the salary example. The cost per month will be about $352. You can also see in 10 years at age 75, the cost rose almost 4 times that amount to $1,322 per month. These costs can eat up a tremendous amount of your pension as you age, since the costs are deducted directly from your monthly pension check. As an alternative, many people may choose to go to the private market to get low-cost term insurance to make sure temporary expenses like the mortgage and education costs get covered, and some people may even choose to get some form of permanent insurance that have a more level premium payment. If you plan to get insurance from the private market, it's better to do it sooner rather than later to lock in a lower premium payment. Another route that some retirees choose to go is to totally self-fund any income needs or debt coverage with their savings and investments. So, is FEGLI worth keeping in retirement? Most people choose to keep basic insurance with the 75% reduction plan while foregoing or reducing option B due to the high cost. Your decision will ultimately depend on your income, your existing health condition, and your coverage needs. If you received any value from this video, please click the like button. Also, if you have any comments or questions about FEGLI, federal benefits, or retirement planning, you can add them in the comment section below. Or you can email us at ask@fedwayfinancial.com. Thanks for watching, and we'll see you on the next Money Briefing.